Good afternoon, everybody. Uneducated Economist here. I was just reading an article out of the Financial Times talking about, what was the title of it? Investors flee junk bonds for concerns over or U.S. junk bonds for fear over the economy? Something like that. Anyway, like always, I'll leave a link down in the description for you guys. After I read that article, I thought, this really reminds me of that Brian Reynolds interview on Real Vision. So I went back and I listened to that interview, and it was a really good one. So I'm going to leave a link down in the description for that as well. Because what Brian was describing in that video was something called a daisy chain of financial engineering. I think that's what he referred to it as. Because what he is describing in there is how pension funds are underfunded. And these underfunded pension funds are looking for a higher yield, and they're finding it in these junk bonds, in these high yielding corporate debt. And now, just to kind of briefly describe the daisy chain that he is referring to, is that these pension funds who are underfunded are now seeking to have governments raise taxes in order to make up for the underfunded pensions that they have. So, they promise this much, they only have this much. They want to tax and invest to try and fill that gap. And so what these guys are doing is they're taking these tax dollars, investing it in this corporate debt, or in this, in these high yielding debt, which is getting money to these corporations who are in turn buying back their own stock. And so this is the daisy chain of financial engineering that he is referring to. Now, what I found interesting in the interview is that when they got to talking about this and how this can create a crisis within the markets, because once the way they kind of describe it is that buying into debt, buying like bonds, it's like a goat or a highway going in and a goat trail coming out. So when the market is hot and things are going up, there's plenty of people buying in, there's plenty of investment, everybody's really happy with it. But the moment that it reverses, nobody wants it. Nobody wants to buy bonds when the prices are going down. And so it's very devastating to a lot of these investors who, end up having to take a serious loss on their investment when the markets turn. Now, you also think about it like these corporations who are borrowing all this money, they have to pay those bonds back. And if you cannot take out more debt to pay back the old debt plus interest, then what do? If you can't take out more debt, well, then you have to take it from profits, or you have to sell your stock. So you can see how this can cause a very serious downturn in the market if they do not have enough buyers into this high yielding debt. And so now a lot of people will say, well, yeah, but the Federal Reserve is stepping in and buying all this, but they're really not. They set up a lending facility, a special purpose vehicle to buy these high yielding corporate debt ETFs, but they hardly done it. They invested some into it, a little bit to assure the markets that yes, we as the Fed will buy these corporations bonds. But really, most of what's been purchased has been done by the private investment companies, by whether it be pension funds or regular investors or whatever. But the Federal Reserve, they're not causing that to happen. Well, they are causing it to happen by saying they'll buy those bonds, but they're not causing it to happen by actually flooding it with money. That's not them. This is their credible threat that's causing it to take place. And so I think about what it is that we can expect for the future going in. Here we are. We got low interest rates. We have an issue already starting to rise inside of the high yielding debt. And if these corporations, these zombie corporations essentially now, cannot take out this debt to pay off the old debt, then they have to start selling into their own, basically start eating themselves to pay it. sell their stock off that they have been purchasing, whether they lay off or however they work their system in order to achieve their responsibilities to these bondholders. But that's essentially what I see taking place here, is that as we continue forward here, we're going to find more of a situation where the investors out there don't want this high yielding debt, this risky stuff. I mean, it was all good when the interest rates are dropping, but now that they've kind of hit bottom, unless they go negative, I mean, the demand for this stuff is getting very leery. And if they start pulling out, it's going to be it can lead to a very serious financial crisis where interest rates just go skyrocketing in order to acquire this debt that they need. I think about this stuff quite a bit. Nobody that I know invests their time into trying to understand this kind of thing. Like, they literally, I've heard people say, oh, well, there's nothing you can do about it. And that just drives me crazy, because there is something you can do about it. You can live your life differently. You can move your money in different directions. There is a lot that you can do about it. It's not that there's nothing that can be done. And, wrapping your head around this kind of stuff and trying to think of what the possibilities of the future could be, it's wide open out there. Nobody can predict the future. But when you have a situation that is brewing like this, with these low interest rates and these corporations going deeper and deeper into debt, and everybody going, it's not just corporations, everybody. The housing market, with the lumber prices, these builders right now are going to suffer a very serious situation when these prices come back down, because they have paid a lot of money to build these. People who are framing a house right now are paying top dollar to do it. And with inventory levels as low as they are and the demand for homes as high as it is, it doesn't seem at the time right now that there's a problem, because this house is going to sell for a profit. But at some point, everything's going to peak. The low inventory is going to reverse, and we're going to start having higher inventory. We're going to start having lower lumber prices. We're going to start having higher interest rates. All this stuff is at some point in the future will churn. And when it does, it's going to be a lot of hell for people, as they try to understand how it is that their house is not going up every year. How it is that they could buy this house and then not be able to sell it for a profit. It just, people will have a hard time fathoming that. It was like, I've been in this house for a year, how come I can't sell it for a profit? People are not going to understand that. And when they start seeing that their houses are losing value, then you're going to start seeing a lot of homes come up for sale. When you keep everybody in forbearance, when you keep everybody in forbearance, you're going to create an issue in the future, because just the natural occurrence of foreclosure takes place. I mean, it happens even in a good market when people are have a lot of employment and stuff going on. You have foreclosures. I mean, things happen to people in their lives that they no longer can be part of this contract or this house, and you have to unload it, or and get rid of and foreclose on it or whatever. But if you are in a situation where the government is basically providing this forbearance, then you don't have those naturally occurring foreclosures. I'm not sure how else to describe them, but that's the way I'm going to describe them. Then you don't have those things coming into the market. Then you have a buildup of houses that should be on the market that aren't there because they're in forbearance when they should be in foreclosure. You see what I'm saying? So it's no wonder to me why we have low inventory. It's no wonder to me at all. And if you follow my channel for any length of time, you know why the lumber prices are so high. All this will change at some point, even though it's hard to see that right now. All right, Uneducated Economist, you guys let me know.